And welcome back. In this session, we're going to take a look at managing institutional portfolios with a particular focus on foundations and financial institutions. In the previous session, we had a look at pension plans, and in particular, our focus was on the defined benefit pension plans. This session, we're going to take a look more at the philanthropic organizations, the foundations that are set up by individuals or by families quite often, sometimes by a group of individuals, with a particular social, educational, charitable, or religious activity in mind. Historically, these foundations have been set up by families to create a perpetual influence for that family and its name. Sometimes when those families give up the family business and pass it along, so that the foundation and the family name lives on well after the original activity is gone. The decision making is essentially done through a board of trustees that are set up by the group and the families, and sometimes those families will carry on running the foundations for years and generations after the original activity. What makes a philanthropic organization foundation is essentially a promise to distribute a proportion of their capital each year, typically about 5% of their average assets. There's information that's provided by the Philanthropic Foundation Association of Canada about foundations. They tell us that there are over 5,000 public foundations and about 5,700 private foundations. Those foundations have total funds under management of about $70 billion. Still relatively small compared to the $1 trillion that we were talking about. We're looking at our pension plans a few minutes ago. Private foundations control about $40 billion, about $30 billion from public foundations. And those foundations provided funding of about $5.6 billion. The biggest foundations in Canada are typically names that you may recognize, including people like Li Ka-shing, the Weston Foundation, the Molson Foundation. In fact, part of my education was paid for by the Molson Foundation. And the McConnell Foundation. The biggest one, a relative newcomer, the MasterCard Foundation, with about $12.7 billion of funds under management. You can see there are other foundations that may be recognizable, including things like the Vancouver Foundation. The Vancouver Foundation is an interesting story. It provides funding to most of the universities, most of the higher education institutions in the lower mainland of BC. Originally, it was set up by one person, a secretary who set aside $1,000 in the 1940s, a lot of money, and this was essentially matched and topped by some of the richest families in Vancouver, a group of 9 families headed by the Van Dusens. Each contributed about $10,000, and that's grown to become the largest foundation, the largest charity on the west coast of Canada. There are foundations that are attached to most activities like universities and medical research. Here in Vancouver Island, we're very much aware of the Vancouver Island University Foundation. There are some foundations which may be less charities and more business strategies. For example, one of the biggest foundations in the world is the IKEA Foundation. Essentially, a foundation owns IKEA. It was set up by the founder of IKEA, and it is largely a way of hiding the management and the ownership of this company and all of the profits inside of this separate company. And IKEA, of course, is famous for being a Swedish company, but they've set up a Dutch organization that operates IKEA. And every year it pays money to the founder and his family to manage that foundation, making it exempt from most taxes. So there are all kinds of good and perhaps less good types of foundations. There are a variety of different types. Company-sponsored is certainly one type. Legally independent of the company that they work for, but with close ties to the original corporation that provided the endowment or the funding. Paid for by a single endowment or by annual contributions, the decision-making is usually separated in the hands of a board of trustees, but strongly influenced by the objectives of the parent organization. And like all foundations, it needs to distribute part of their assets, usually about 5%. For example, you could see that Price Waterhouse as a foundation, which is helping to produce community leadership and also seeking to reinforce the brand value, the brand name, for its parent organization. There are other types of foundation which have a particular purpose in mind. For example, the Maritime Museum Foundation, or perhaps another one that we're familiar with, the BC Museum. Now, those use their resources to conduct a particular type of research or manage a particular type of service. The funds are originally provided by individuals, groups, and families. Decisions are made by a board of trustees independent of the day-to-day operation of that museum, for example, and they have to use a large proportion of their investment income on their operating activity. As mentioned earlier, we have the Royal BC Museum, which, if you haven't seen it, is a great museum right in the middle of Victoria, right by the harbour in Victoria. And you'll see, if you take a look at their website, that they have created this foundation which is used to provide, to sponsor most of the activities of the museum. Community foundations are ones that provide grants for social, educational, charitable purposes, a public charity. Something like the Vancouver Foundation, for example. The United Way is going to be one of the beneficiaries of that foundation, so itself it's a foundation as well. Funds are provided by the public. There may be, or typically are, many different donors. The trustees, the board of directors of that foundation, make the decisions, and they're not subject to a particular minimum spending requirement. Now, when we look at the nature of all of those foundations, and I have just introduced a few, there will be many different variations on those 2 or 3 themes that we've looked at. They typically have a high risk tolerance because a single loss is not going to wipe out a large proportion of their assets, and their spending is flexible. If they have a bad year, they can cut their spending to a certain degree. The return objectives are to preserve the real value of the asset and to see it grow with at least the rate of inflation. And so we want to make sure that the funding levels are going to be sustainable for this generation and for future generations as well. So if perhaps the rate of spending was mandated or required to be 5%, they'll want to also be able to cover their investment expenses, their inflation rate, to make sure that there is no stealing of the future contributions from future generations. The constraints at several different levels. Well, we need to provide liquidity to cover our required 5% level of spending. We say this is a perpetuity because we expect the foundation to live forever, to continue to contribute. Tax concerns are going to be very limited. They're not taxable as a charity, although there may be certain excise taxes that they have to pay. And if they operate an activity which is considered to be a business, those activities might be taxable. They have to comply with whatever the local requirement is for foundations. In the United States, it's something called UMIFA. In Canada, it's mostly done by Revenue Canada. The Directorate of Charities decides whether or not a certain activity is a charitable activity or not. We've seen some recent interesting examples of when a charity really isn't a charity. You may remember that the Trump Foundation was used for all kinds of non-charitable activities, like buying portraits of Donald Trump and paying for his kids' scout fees, things that really had nothing to do with charitable activities. And in the end, Trump was required to pay a lot of money to 8 different charities, and his kids were actually barred from participating in charities for a period of time. Under unique circumstances, many foundations may actually have large holdings in a single company. The Bill and Melinda Gates Foundation, when it was originally set up, had a lot of its assets in Microsoft stock because that was the original founding capital for the foundation, and over time that was reduced. So they did actually have a lot of exposure to one company, which could be a concern. Endowments are a bit different from foundations in that their purpose is essentially to provide a certain amount of cash to a certain activity for a period of time. For example, funding a university charity, or providing a particular type of program support. There are risk objectives for an endowment. They have to be consistent with providing stable, real income over a period of time, that intergenerational equity we talked about earlier. The risks can be higher if they can alter their spending activities, and if they are going to try to provide an excess in one period and a little bit less in another period, that can also allow them to take on bigger risks for certain periods of time. They want to maintain sustainable real income, so that means their return has to be high enough to cover the endowment, plus also to provide for inflation. Some constraints, well, liquidity, they need to cover their short-term spending needs. Time horizon is long-term, perhaps perpetual. Tax considerations are minimal. Again, we have UMIFA and maintenance of tax status in Canada in particular. And the unique circumstances will vary according to each endowment. Now, that's a very quick introduction to foundations. Financial institutions have a variety of different demands as well. Insurance companies are important, and when we talk about insurance companies, we look separately at the two different types. Life insurance companies provide an endowment or an annuity to individuals, essentially paying out in the case of death, but also providing annuity payments to their subscribers, to the people who are paying for the insurance. So they have a very different set of circumstances to companies like car insurance, home insurance, liability insurance companies, and we call those the general insurance companies. So for life insurance companies specifically, those companies that collect premiums from individuals and eventually will pay out perhaps a death or disability benefit, but most importantly will provide an annuity to people at the end of the pension's life. Well, their risk objectives, they have to worry about significant future liabilities, and things like interest rate sensitivity might be a big part of that. They also have to have the asset liability management I talked about in our previous video, and make sure that they are able to meet all of their expected liabilities and the payment of those annuities from their current base of assets. So they have to have a matching over time of assets and liabilities. And they can invest more if they have surplus funds. A return objective, well, to earn a positive rate of return in excess of the cost of raising those funds. So a positive spread over the interest rates paid by subscribers, the policyholders. Some of the constraints, well, because this is a very long-term type of investment, liquidity is typically not a problem. It's predictable how much we're going to have to pay out at each period in time because of things like annuities and also mortality tables. Interest rate volatility might also affect that. Very long time horizon, and we might actually have to look at this in parts or segments because of different classes of liabilities. Tax concerns, well, they are commercial entities and they're subject to tax. Very heavily regulated because the risk of an insurance company failing has got important knock-on effects to the companies or the individuals, the policyholders who are insured, and therefore to society. So they have to follow certain rules, and those rules are going to be enforced by particular agencies, government agencies that are going to regulate them. Unique circumstances would of course vary by insurer. Now, the general insurance or the non-life insurance companies are ones that are subject to periodic demands on their equity. For example, if our insurance company provides hurricane insurance and there's a hurricane, that could create a large liquidity requirement for one particular period. Or fire insurance if there's a major forest fire, and so on. So they have to be able to cover claims if there's a particular event, something that they haven't been able to reinsure themselves. So the claims risk is going to be unpredictable. They have low risk tolerance. Return objective, well, they have to be competitive. They have to provide profitability. In fact, general insurance companies make more money from their investing activities typically than they make from their insurance activities. So if you think about a company like ICBC, they make money from selling insurance for a premium to individual investors, but then that premium is going to sit in their investment funds for a period of 12 or 18 months before there's an actual claim against it. And so over the life of that policy, they have to be competitive in selling the insurance to a certain degree, but also they have to be able to make money from the funds that are invested. So the return objective is really about being competitive. Certain other constraints, well, liquidity needs. They may have a large single claim. If it is a company like ICBC or any other car insurer, perhaps hail could cause a single event that's going to cause a large drain against the fund. So they have to be able to sell investments in order to provide that. That means those investments have to be marketable. This can be complicated because the taxation for the funds that are inside the company is different from the actual insuring activities. And they're likely to be significant legal and regulatory factors. Banks are also important financial institutions. Their risk objectives are going to be constrained by the asset liability management of the principal activity of the bank. So if they're lending money or if they're underwriting investment products, there's going to be an asset liability management problem that's going to remain after their banking operations. If everybody wants long-term loans, the assets of the bank, and short-term liabilities, the deposits, are going to be used to fund that, there's already an asset liability management mismatch that has to be fixed. So that's going to be part of the overall banking problem. And this means that they have below average risk tolerance with the funds that are available to reinvest into investments. Return objective, well, I want to make sure they have more money paid to depositors than the amount that they're going to be receiving, than they're going to be paying for their own investments. So they want to make sure they have a positive spread, that they're able to create some kind of positive return. Liquidity, they have to be able to cover their outflows. So if there are going to be regular claims on their assets, withdrawal of funds, they have to be able to cover that. And investments usually are the buffer between the depositors and the borrowers. Tax concerns, well, typically their activities are fully taxable. There are going to be some restrictions through the bank regulators, and bank regulators typically require a certain amount of liquidity remains in the bank because of the systemic risk, the risk of one bank taking down a lot of other banks. In particular, in the United States, that's described as the Volcker Rule that was brought in after 2008 and the financial collapse, which essentially says that investment-grade securities are going to be required in order to provide some kind of collateral against that risk. There are a lot of other types of financial institutions. We don't go into detail on all of them, but for example, commodity pools, hedge funds, other dedicated investment banks are investment intermediaries whose sole purpose is to draw funds from a market and use that to invest. There are going to be specific objectives and risk profiles that are going to be related to each of those, and we'll talk about that a little bit later on in the course. One other category that the textbook doesn't cover has become very important in the last few years are family offices. Here we're talking about the organizations that are used to manage the wealth of the super rich. The super rich, partly because of the increase in the disparities in wealth between the poor and the rich, have grown over time. And the total value of family offices probably in the range of $3 or $4 trillion over perhaps a worldwide base of maybe 70 or 80 trillion dollars of all of the assets that we have. The average size of a family office in the range of 500 million to $1 billion. Probably the world's first family office was set up by the Rockefeller Foundation in the 1880s in order to manage the wealth of their founder, John Rockefeller, who needed to be able to provide intergenerational transfer of wealth to the rest of the family. Probably the world's largest today, and I'm not sure this is still true because of all the new billionaires and even trillionaires we may have created. The Soros Family Trust or Family Foundation is worth about $25 billion. Alibaba's founder, Jack Ma, the Hilton founders, the Pritzkers, the Walmart founders, the family who owns Keurig and Dr. Pepper all have got well-recognized and very well-funded family foundations. They're big enough that when investments, companies are looking for a new investment, they compete with the largest investment banks to provide that money. I'll show you some of those examples. And from this chart from The Economist a couple of years ago, we can see that one of the most remarkable things is that the distribution of these super wealthy family offices is increasingly shifting away from the Americas and Europe and into the developing world. So Asia Pacific, increasingly home to a lot of these super wealthy families. They also, as well as providing investment management services, may provide other services to the family. They may manage some of the real estate for the family, provide jets for family members, the things that we think about as the concierge services provided by a top-end hotel. And you'll see the type of assets that they invest in. Well, clearly things like bonds and equities are important. But here's where it gets interesting. They're also investing in things like private equity, providing funding for startup businesses, for fast-growing businesses, with perhaps 14 to 20% of the investment provided either through private equity funds or directly in investments. Things like the Dr. Pepper investment by that one family, the Ryman family, that was looking for an investment, and they decided to buy the business. That would be a direct investment. Property, a big part of that. Investment in other funds, like hedge funds. Investment in commodities may also be part of that. So they're a lot more than just investors in traditional funds. We have looked in this session at a lot of different types of institutional portfolios. Pension funds, in terms of the total value of funds under management, by far the largest institutional portfolios. But public and private foundations, philanthropic foundations typically, are going to be a big part of funds that are managed for investors. Inside of financial institutions, life insurance are the biggest investors, followed by general insurance. Banks, investment banks, are going to also be significant investors, as well as things like hedge funds and family offices. The risk return, liquidity, time horizon, tax and legal requirements are going to be very different for each of these type of investors. And in order to be able to manage these funds, we have to be clear of all of these factors. Thanks for your interest, and I look forward to talking to you in our next video.